Welcome to the Swedish Investor. Today we're diving into the biggest mistakes new investors make with insights from the legendary Warren Buffett. In this video, we're going to break down 12 common mistakes that new investors often make, and more importantly, we'll show you how to avoid them. We'll be drawing wisdom from the Oracle of Omaha himself, Warren Buffett, one of the most successful investors of all time. So, whether you're just starting to dip your toes into the stock market or you've already made a few trades, this video is for you. Let's get started. One of the biggest mistakes new investors make is trying to time the market. Warren Buffett himself has said that he doesn't try to time the market. Instead, he focuses on finding great businesses at fair prices and holding them for the long term. As he famously said, the stock market is a device for transferring money from the impatient to the patient. Remember, time in the market is more important than timing the market. Another common mistake is getting emotionally attached to your purchasing price. But remember, the price you paid is irrelevant. What matters is the future potential of the company. Always approach your investments with a fresh perspective, focusing on the company's future prospects, not your past purchase price. The future performance of a company is independent of its past price. We've all seen those companies that promise the moon and the stars, projecting massive growth rates that seem too good to be true. Don't fall for the hype. Very few companies can sustain high growth rates over the long term. Be wary of companies with sky-high valuations and unrealistic growth projections. Always do your due diligence and make sure the numbers add up. Look for sustainable growth, not just flashy numbers. Leverage or borrowing money to invest can amplify your returns, but it can also magnify your losses. Warren Buffett has famously said, "If you're smart, you don't need it, and if you're dumb, you shouldn't be using it." Imagine a hedge fund manager who uses leverage to short a stock, believing it will go down, but the stock unexpectedly surges, triggering a margin call. The manager is forced to sell other assets at a loss to cover the position, leading to a downward spiral. Avoid excessive leverage at all costs. It's simply not worth the risk. It's easy to get bogged down in the details of investing, analyzing every little piece of data, but sometimes this can lead to analysis paralysis, where you overthink things and miss the bigger picture. Warren Buffett focuses on three key factors: the future economics of the business, the quality of the management team, and the price he's paying. Don't overcomplicate things. Focus on the fundamentals. If it all makes sense, invest. If not, move on. Many new investors believe that complex investment strategies are the key to success. But the truth is, the simpler, the better. Warren Buffett prefers to invest in businesses that he understands, businesses that are straightforward and easy to analyze. Don't be afraid to stick to what you know. You don't need to be a rocket scientist to be a successful investor. Some investors get comfortable in a particular niche or sector and miss out on opportunities in other areas. The market is vast and constantly evolving. Be open to exploring different sectors and industries. Diversification is key, but don't be afraid to venture outside your comfort zone. The more you know, the better equipped you'll be to identify promising investment opportunities. In the world of investing, patience is not just a virtue, it's a necessity. Many new investors feel the need to be constantly buying and selling, trying to time the market and chase the next hot stock. But this constant activity can be detrimental to your returns. Don't be afraid to sit on the sidelines and wait for the right pitch. Sometimes the best investment decisions are the ones you don't make. Diversification is crucial for managing risk, but too much of a good thing can be counterproductive. Spreading your investments too thin can dilute your returns and make it difficult to track your portfolio effectively. Instead of owning hundreds of stocks, focus on a select few high-quality companies that you believe in. Remember, it's better to own a few great businesses than a tiny piece of everything. Focused investing can lead to better results. We all like to be right, and it's human nature to seek out information that confirms our existing beliefs. But in investing, this can be a recipe for disaster. Be open to different perspectives and be willing to change your mind when presented with new information. Remember, the market is always right, and it's better to learn from your mistakes than to stubbornly cling to losing positions. It's tempting to follow the crowd, especially when everyone seems to be making money in a particular stock or sector. But remember, the crowd is often wrong, and by the time everyone is piling into an investment, it's probably too late. Warren Buffett and his partner Charlie Munger are known for their contrarian approach to investing. Trust your own analysis and don't be afraid to be different. The best investments are often the ones that nobody else sees. Sometimes the biggest mistakes we make are the ones of omission, the opportunities we miss because we hesitate or overthink things. When you've done your research, believe in a company, and the price is right, don't be afraid to pull the trigger. Remember, fortune favors the bold. This doesn't mean you should rush into every investment opportunity, but when you've identified a solid opportunity that aligns with your investment philosophy, don't let fear or hesitation hold you back. Understanding and avoiding these 12 critical mistakes can significantly enhance your investment strategy. Remember, investing is a journey, not a race. Be patient, stay disciplined, and never stop learning. Share your experiences and insights in the comments below. Happy investing!